All right. Good afternoon, everybody, and welcome to my weekly market update. Today is Monday, the 10th of August. I know I've got some people that are joining me right now on Facebook and some people that are joining me on Zoom. So just remember, this is interactive. If you have questions, please feel free to post them. If you're on Zoom, post them to the Zoom chat. If you're on Facebook, post them to Facebook chat. I see Zoom chat a lot faster than I see Facebook chat. So I will get to the Facebook ones as I can. But let's go ahead and get started. If you're watching this recorded, go ahead and post a comment or shoot me an email at john@johnloneking.com, and I'd be happy to answer any of your questions that way as well. All right, so I got to pull up the chat here real quick. Boom, I got the chat up. And away I go. So here's our update for this week. What are we going to talk about? We're going to talk about a couple of things like we normally talk about: a rate update, where we're at with rates and the market, a forbearance update, some new information about forbearance that may create some questions on where the forbearance numbers are going to go. So I'll share that with you. We're going to talk about a flaw in pandemic-related loan reporting. This was just caught last week. Again, it's more just how we're perceiving the impact of the pandemic. And I think part of the theme you're going to hear from me today is we're having a hard time trusting numbers. Just as simple as the state of California and the reporting of the number of people that have COVID. And we can't really trust the numbers right now because they're not reporting those accurately. A lot of things that I'm seeing right now, we're having major questions about, can we trust the data that we're getting? And a lot of the stuff I'm going to talk about today has that as an overriding theme. We're going to cover the July jobs report and what happened on that report and what it really means. And then we're going to talk about upcoming webinars and a little bit of time for Q&A. So again, this will take no longer than 30 minutes, probably closer to 15 or 20 minutes today to get through most of this stuff. So first and foremost, where are we at with interest rates? I teach this every single week, and I talk about where the market has been. We've been watching this since before this time, back in the middle of March. We've seen some pretty heavy swings. As a reminder, what this chart represents is what the market is doing for how much mortgage companies pay to the long-term investor. The higher this payment, the lower the interest rate. So just think of this chart inverted, like we want this to be the other way around. As this number goes up, it means interest rates are going down. And so what we're seeing is rates, or at least rates should be going down, which is, I think, the operative key here that we've been talking about. We're continuing to see the rate market get better. If you missed last week's webinar, go back and watch it, because last week's webinar, I demonstrated more clearly the relationship between the three markets. So you've got the treasury market, you've got the mortgage-backed securities market, and then you have the rate market of what we as the mortgage companies are charging consumers. And there is a serious disconnect between all three of those markets right now. This is the middle of the three markets. This is what mortgage companies are being charged, but this is not what we're charging our customers. We're not seeing interest rates drop very much. We're seeing rates on a 30-year fixed right now hovering between 2.75, maybe 2.625. You can buy it down to 2.5, and on the high end, 2.99. So we're in the high twos. Phenomenal interest rates. But the truth is, we were in the high twos back around here. Rates should be a lot lower right now than where they were. Same theme I keep saying over and over again. I keep beating the same drum. If you're thinking about getting a loan and you're buying a home, lock it right away. But if you're in a position where you think that you are going to refinance down the road, you are much better off waiting and not locking the interest rate. Now, you shouldn't wait to get in line because the system is very backed up, but you should not be locking interest rates right away on a refinance. If you're buying a home, lock that rate right away. You don't want to have to worry about the rate going up during the time that you're in escrow, because you have these wild movements. And that's the key that I want people to understand. From July, 1st of July approximately. And remember, up is good on this chart. 1st of July, we were here, things went down and then up, and through July, they stayed pretty steady. August, late July into August is when rates have started getting significantly better, or at least the market has been getting better, and rates themselves should be improving more than they are. But you don't want to be caught in one of these downward swings. You don't want to have gotten contract for a home, you have a 30-day escrow, and you decide, I'm going to wait because I know rates are going to go lower. Well, a month later, they did go lower. But a week later, rates went up. That's the volatility you have to be careful about. You see these long-term movements, and you see that in the short term, huge amount of volatility. Long term, it's going the right direction, exactly as I had expected, and we're continuing to see that play out. So just make sure you're giving the right advice to your consumers that if you're refinancing, you don't need to lock. You shouldn't lock. It is a bad idea to lock up front. But if you're purchasing, lock as soon as you can because you cannot tolerate these short-term movements. All right, let's switch over and talk about forbearance. So here's what's going on with forbearance right now. As you can see, the numbers have skyrocketed as we talked back in April, May, June, July, and then at the end of June, they start coming down. They kind of flatten out, and they're starting to come down at the end of July. That all looks good overall, but not so much. So there was an article that was published last week that said another wave of forbearances are probably on the way. And here's why. Because the recent drop is really due to the expiration of the initial plan. We've all seen the articles. You've got the banks that put people into forbearance and they didn't know they were getting into forbearance. You've got people who accidentally clicked a button and didn't plan on getting into forbearance. Well, that initial forbearance period was 3 months long. We had 2.5 million forbearances that expired at the end of June, another 500,000 that expired at the end of July. That's 3 million of these people that dropped. So we went way down overall in forbearances simply because they expired. Most of the forbearances that expired were people who didn't need forbearance. So you've got to be careful as we're looking at these numbers to say, hey, that's great, forbearance is improving, we're getting out of the woods. Not necessarily. I'll repeat, as I said in the beginning, I have a few people who have joined both on Facebook and on Zoom since the beginning and say, my kind of theme of the day is be careful about the numbers and be careful about trusting the numbers because I'm worried about the accuracy of the numbers that we're seeing. 66% of the remaining plans were extended, most for 90 days, okay? Some of them were extended for 180 days or longer, but they're giving 90-day extensions and they're going to keep kicking the can 3 months, hoping that person can get back on their feet without having to do a modification. But this is kind of hiding the numbers. It's putting them into a forbearance and hoping the problem goes away temporarily. Black Knight, who put together this report, expects there to be a rise in forbearances, very simply because of the spike in coronavirus cases that we have seen and the expiration of unemployment benefits. And I haven't caught up my weekend reading. I know there was some politicking going on about the unemployment benefit extensions, and I'm not real clear on all of those pieces yet. But from what I did read, it clearly isn't a continuation of the plan that they had been on since the CARES Act was enacted in March. So we're going to have a pretty decent reduction in the amount of unemployment benefits. And you have no idea how many people we get calling us every day saying, hey, I don't have a job right now, but I've got this great unemployment income. Can I buy a house? And that's great that they want to buy a house. But the reality is we can't count that unemployment income, even if it's as good or better than their current income. It's not long-term stable income. And that's our concern. So as we think about forbearances and kind of the flaw in the numbers, here's another major flaw that was just uncovered last week. And what it comes down to is the government's reporting lenders reporting numbers on delinquencies of consumer debt. That could be credit cards, car loans, and mortgages. And they've reported low levels of hardship overall. Here's the flaw that this DV01 company came up with or determined or realized that when the government sampled the data, they're pulling the data from the actual company that originated the mortgage. That's not the company that actually has the data for mortgage companies. So if you're thinking about a credit card company or you're thinking about a car loan or any other consumer debt, typically the lender does everything in-house. They are the company that started the mortgage or the company that, or not the mortgage, or the company that started the debt, that serviced the debt, that chased down the delinquencies. But mortgage banks have many different parties in the process. And so when you ask the wrong person to give a sample of how many people are having modifications or hardship with their mortgage, there's not an alignment with those numbers. And there's some pretty serious data that this company DV1 thinks was significantly missed. They came out last week and said they believe there were numerous cases of underreported or omitted modification activity. What's a modification? Really, it's any change to the original terms on the loan. So maybe they're extending the loan term out longer to lower the monthly payment. Maybe they're taking some payments that you missed and adding them to the end of the mortgage term. Maybe they're temporarily or permanently dropping your interest rate or forgiving some interest. I haven't heard anybody forgiving any principal because we don't have a decline in market value like we did back at the Great Recession, 12 years ago. So what I'm seeing though is I'm seeing in these numbers upwards of 30%, based on the sample data, 30% of mortgage holders had some form of modification done. Now, that's a sample. We don't know if that's really the truth, but it is a significantly higher number than the single digit numbers that the government's reporting, saying, hey, 1, 2, 4, 5% range of people that are delinquent and having some form of modification done on their mortgage. This company's proposing they're stating they did 900 sample loans. 233 of them were in some form of modification. That's about a third of the loans, or close to 30% of the loans that were in some form of modification. What that's creating right now is investor uncertainty. It means you've got people who are investing in mortgages that are concerned about, hey, is this loan actually going to pay me long term? And this is one of the major disconnects right now between where the rates should be and where they actually are. And it's also one of the big reasons why we're not seeing really good interest rates on investment properties. Although I'll tell you real quick, that's gotten a lot better. I probably should do a quick recap of that next week, but I'll tell you, a month, 2 months ago, I did one of these webinars and I told you guys that there's a big difference between getting an investment property loan and a single family or a primary residence loan. You're going to pay a whole lot more in fee to get a decent interest rate on an investment property. Those numbers have actually come down. So I was running some numbers last week, and for somebody with decent equity on an investment property, we're between 3.25% and 3.5% on a 30-year fix, paying 1 point. That's super good compared with what I was telling you guys a month or two ago, was you'd have to pay 2.5 points to get something in the low 3s, and to pay 1 point, you'd be at like 5%. So we've definitely seen the investment property loan market calm down a little bit, and we're able to deliver much better interest rates on investment properties, but it's creating more uncertainty with the investors that say, hey, I'm worried when I take out a mortgage for somebody, I don't know how long they're actually going to pay me this mortgage. Because based on this data, 30% of them might need that loan modified down the road, and the other 70% might refinance if rates drop even further in the next 6 to 12 months. So there's a lot of uncertainty. If you were an investor buying mortgages, you're writing a check up front for the privilege of owning that mortgage and receiving the interest on that mortgage. And if you think, hey, 1 out of 3 people that I do a mortgage for are gonna need a modification, and the other 70% might refinance if rates fall, how big of a check are you willing to write up front for the privilege of receiving small checks over the next 30 years when that might only be over the next 6 months? A lot of investor uncertainty continues in the market, and it's something that is, again, do we explain this to our clients and go this deep into it? No, I'm explaining it to you so you understand why there's such a disconnect in the market between what you see and you think should be true and what really is the truth. All right, so let's dive into the July jobs report. So I found this chart and I like it because it kind of gives you an idea of the unemployment rate. So this is going back from July of 2018 to July of 2020. And we were hovering just under 4%, up and down just a little bit until we hit March. And then March, it jumped up a little bit. And then April, it skyrocketed. And then every month since April, we've seen the unemployment number drop, showing that in a different way. This is the number of jobs created or lost during the same period. What you're seeing is anywhere from, by the way, this is 5,000 thousands. So that would be 5 million, okay? They just added 3 more zeros or deleted the 3 zeros. So what you've got is 50 to 250,000 jobs that were gained every single month, again, varying a little bit. And then in March, we lost a significant amount of jobs. In April, we lost a really significant number of jobs. But May, June, and July, and the jobs numbers are recovering. That on the surface sounds like a good number. 1.8 million jobs were added compared to the normal month of 50 to 250. Unemployment rates down to 10.2%. Here's the problem. The market doesn't care because the market realizes they really can't trust the data. It's kind of like what we're seeing with the issues that I explained a couple minutes ago about delinquencies. It's kind of like what we're seeing in the state of California with the COVID rate and the fact that the state now can't keep track of how many people have COVID. The statistics are all over the board, and the economic implications of these statistics really are being ignored because they're saying, you know what, we really don't know. We have a lot of people still out of work. It says things are getting better, but it doesn't feel like things are getting better. And feeling is super important. And here's something I want to give you that is, we've all heard it, and I think in some way or another we all think that there's a lot of truth to it, which is the media chooses whether they want to give our clients permission to buy a home or not. And what I mean by that is people are listening to their friends, they're listening to their family, listening to the media, and the media is telling you, hey, is it a good idea to buy a home or not? So this is something that you've probably seen before, the Homebuyer Sentiment Index. And what this is showing over the last 2 years, what percentage of the people who were asked, hey, is now a good time to buy, or is it a bad time to buy? So they were asked that question, and specifically, if someone was asked, is now a good time to buy? This month, 53% of the people said, yes, it's a good time to buy. They also asked other people, and again, it's all about how you ask the question. They asked another group of people, is now a bad time to buy? 38% of the respondents said, yeah, it's a bad time to buy. So what they do is this home buyer sentiment basically says, well, hey, let's just subtract the difference. If 53% of the people said, yes, it's a good time to buy, and 38% of the people said, yes, it's a bad time to buy, that means that a net result, 15% of the people really do think it's a good time to buy. Okay, crazy way they come up with these numbers. I love statistics. 82% of statistics are made up, including the one that I just made up, about 82% of them being made up. And this is the problem. The media is putting this information out there saying, oh my gosh, it's a bad time to buy, because only 15% of people who were asked if it's a good time to buy said that it's a good time to buy. Well, that's not true. 53% of the people asked if it was a good time to buy said it was a good time to buy, and only 38% of the ones that were asked if it's a bad time to buy said it was a bad time to buy. But I don't feel this in the streets. I don't think any of you guys are feeling this in the streets. The home buyer sentiment right now is ferocious. The appetite of people wanting to buy homes is amazing. The problem is a report like this gets released, and now your client, unbeknownst to you, is reading this saying, uh-oh, maybe I shouldn't buy a house right now. I just want you to be aware of that is in the media. I want you to be aware of that information that's being put out there, because it is clouding the thought process and the decision-making of the people that you are working with and the people that I am working with. We have to work together to help them accomplish their goals. The key thing I keep reminding people of, because they keep asking me, and I bet they're asking you too, is, John, I know prices are going to drop because they always drop in a recession. That just isn't true. You've got to remind them of the fact that is not true. 3 of the last 5 recessions, housing prices went up. And the reason why is because in a recession, interest rates go down. And when you can buy the same house with a lower payment, most people won't buy the same house with a lower payment. They'll buy a more expensive house with the same monthly payment. And therefore, you have more competition at the higher purchase prices. I'm talking to people right now that are sharing with me anecdotally. You guys know the statistics better than I do, but anecdotally, the market is hot across the entire spectrum of price ranges. Like we often have times where I talk about, hey, it's a tale of 2 markets, and the first-time home buyer, low end of the market's really hot, and the high end isn't, or vice versa. Demand is super high across all of the ranges of price ranges. And I think that really has to do with the fact that interest rates are super, super low, okay? All-time low, kind of super low, which is cool, because every week I can say we have an all-time low interest rate, and I'm not lying, because overall rates are continuing to go down week by week. But just be careful about the emotions of your buyers and the emotions of your seller, because that really is your number one job, is to help them keep their emotions in check with reality. Doesn't mean you can make them emotionless, but you have to keep it in check with reality and help them understand where it is appropriate and where it's not appropriate. All right, so a couple of final things I want to cover. We got some good news from VA that we actually have specific guidelines on what we will do for someone who has been in forbearance. Here's what VA says. Remember, I'll share in a minute a recap of conventional, but we have guidelines for Fannie Mae and Freddie Mac. For VA specifically, if someone is trying to do a new VA loan and they had a mortgage that was in forbearance, they simply need a letter explaining why they went into forbearance, evidence and documentation that the cause has been corrected. There is no waiting period. after a forbearance on a VA loan. Super, super, super good news, because we did not have any guidance on that up until now. If that person happens to want to refinance the mortgage, they do have to make 6 on-time payments after the forbearance in order to qualify to refinance. So if you know somebody who was looking to refinance after a forbearance and they have a VA loan, they've got to be back on the horse with 6 on-time payments in order to qualify for a VA refinance. As a refresher, conventional and FHA loans. So conventional guidelines were released back in May. They said, look, if you were in forbearance, but you were never late, or if you were in forbearance and you skipped payments, but you paid them all back and caught up on all the payments that you were behind, then you can qualify to purchase a home or refinance a home immediately with 0 waiting period. Otherwise, if you did miss some payments, then you simply have to make 3 on-time payments after getting back onto a payment plan. And so once the forbearance period's over, you're given a new monthly payment, you make 3 on-time payments, you never have to catch up the old payments, and you qualify to purchase or refinance a home as long as the new loan is conventional, backed by Fannie Mae or Freddie Mac. FHA has not given us any better guidance than what we've had all along. They basically say, if we're trying to do a new FHA loan for someone who has been in forbearance, we cannot do a loan for that person unless we can prove that they were never late and paid all the mortgages on time. FHA hasn't even given us a time frame. We're basically saying we think at the 1-year mark, you'll be able to qualify for an FHA loan if you missed payments in a forbearance. But right now, FHA has not even said that. So if you have someone who is trying to do an FHA loan that missed payments through forbearance, they are not eligible for FHA. They are eligible for conventional as long as they caught up those payments or they had 3 on-time payments, and they're eligible for a VA loan. Obviously, they have to be a veteran, and as long as they had a good explanation for what happened, and we can see that the problem that caused the issue has been corrected. All right, guys, if you have questions about this or anything I've talked about so far, feel free to post them onto Zoom chat or post them onto Facebook chat. I've got a group of people on both. And aside from that, the only other thing I want to talk about is my upcoming webinars. Right this week, Thursday night, the 13th, I am going to be doing a webinar on how to refinance or purchase a home and get funds for renovation at the same time. We're in a super, super tight housing market. And in that tight housing market, it is hard to find the right home in the right neighborhood for that buyer that you're out shopping for. Renovation loans will help you buy the ugly home that nobody else wants and turn it into the most beautiful home at the prom, or the most beautiful girl at the prom, or whatever. I mix my metaphors. You get my point, okay? So the point is, no, don't bring a home to the prom. Just so you know, that's not a good idea. It's frowned upon by administration, especially because there would be no prom probably. All right, moving on. After this week, I'm going to be doing a webinar next week on the 6 steps of financial freedom. So I help people get into the biggest amount of debt in their life, and I want to help give them some guidance on how to get out of debt. The week after that, on the 27th, I'll be doing a first-time homebuyer webinar talking about tips and tricks, down payment assistance, the process and how it works from start to finish. All of these are realtor neutral webinars. So I'd love for all of you guys to join. I think it's good information for you guys to have. You can send your buyers here. I will not be promoting any one realtor. I won't let any realtor promote themselves. It is simply informative and an opportunity to educate your buyers on these topics. So if they are interested, please, yourself or anybody that you know that wants to go, send them to rsvpwithjohn.com to register right there. Aside from that, gang, that is all I've got. I am 6 minutes early today for my promised 30 minutes, so I can give you an extra 6 minutes back in your day, unless you have any questions. Otherwise, have an absolutely amazing week, and don't forget about me when you have anybody who's looking to purchase or refinance a home. I'd love the opportunity to serve them, and y'all have a great day. Talk to you soon. Bye-bye.